Good morning, everyone. Thanks for joining. It's Memorial Day, so first of all, I want to say that it is Memorial Day, and I appreciate the sacrifice of those who lost their lives, sacrificed their lives for us to be here and to be able to engage in these sorts of discussions openly and to have the freedom to be able to spend time with our families and to be able to have economic prosperity and so on. So those who sacrifice their lives for this as well as their families, this is an important day, and I don't want to take away from that. Um, so there was a lot of excitement over the last few days as there was a rumored um, deal with Iran. First, there was a rumor that the U.S. was going to bomb Iran this weekend, and then there was a rumor that the U.S. was going to have a deal with Iran, and there was all sorts of noise around this. And supposedly there was some deal that administration officials and certain sort of, I guess, Trump friends or something, sort of unclear who these people were, many of whom I had not heard of, who showed up on social media defending this supposed deal with Iran over the last couple of days. And then Trump finally, which was my suggestion in this article I published the other day, co-authored, that you just wait for what Trump is actually going to say. And what Trump actually said was underwhelming, I think, um, which is that there is just not a deal right now, and that there may be a deal in the future, but it doesn't sound like the key items that were supposed to be in a U.S. Iran deal are actually settled or have even really been sort of resolved. There's apparently some sort of memorandum of understanding that may have been agreed to. But again, it sounds like from the Trump administration's framing of all of this, it sounds like there's not actually a deal. And so here, let me show this. I'm going to do a few screen shares, and this has crashed before when I've done this, although maybe today it'll be a little better. Okay, so when you read this carefully, this does not sound like someone who has a deal that has been executed. Um, it sounds like if you get past the laugh at the Democrat, whatever nonsense, nothing about the potential deal. Again, potential deal, that's very important. I probably should have gone through and highlighted this. And then things that haven't even been negotiated yet, that struck out to me. And then also, um, the deal with Iran either will be a great and meaningful one or there will be no deal. Okay, so this sounds very hypothetical. This is not an announcement of there's a deal and it's great and it's done and we signed it and that's it. And so, why even talk about this, right? It's Memorial Day. I'm gonna go barbecue later, go to a friend's pool, um, for a barbecue get together. What's the point? Why talk about this? Well, the reason to talk about it is that oil prices are down quite a bit on this, and so um, it's very interesting that that's happening, and very odd, I would argue. And let's see if I can share this. Futures. I like pulling the CME stuff. And yeah, let's see, on the short time frame, oil's up. On the medium time frame, I mean, it's just not even medium, short term, but just not like zoomed in. Oil's down roughly, I think it's like 12% or so in the last 5 days, which is remarkable because in the last 5 days, what's happened is that the Strait of Hormuz has remained closed. And by closed, it's not 100% closed. There are two or three tankers a day, whether it's oil or LPG or LNG, that have been going through the strait. And that even though the U.S. has announced a formal blockade, it appears, let's say, two or three tankers a day are getting through. And so that's not zero, but it's also not new. And someone who I think should have known better, was sort of talking about this pretty publicly, about how there's a trickle and there's a trickle before a flood, which is just nonsense. Like there's been this sort of steady stream at a small level of tankers, and that's already in that number of 10 to 13 million barrels a day of oil and natural gas liquids that have been, essentially oil-like products that have been cut off by the Strait of Hormuz closure. And frankly, actually, that number might be low now because Iranian oil exports have also collapsed. So 5 more days of oil exports not going through, by and large, one would think that the shape of this chart would be the opposite and that prices would be going up, not down. So very interesting and not what you'd expect in my view. So what what do I think about all this? I think that there's this great opportunity here. Um, thus, on my this displayed on this lovely red hat that I'm wearing. And by my comments, you can tell this isn't a massive Trump endorsement. This is a um, opportunity, I think, economic opportunity. None of this is financial advice. I'm not telling you what to do, but I am telling you what I've done and what I'm doing here on Bison Insights and talking about here on Bison Insights. The drilling rig count in the US is up. And I think all of this sort of noise, it does delay, I think, a little bit the drilling boom that we're experiencing, but it's still underway. And so maybe it means that there will be 10 rigs added a week instead of 20, or 5 rigs added a week instead of 10, but still a lot of oil rigs getting added. The inflection's here. And the market's booming. And I was sharing with some of the Bison Insight subscribers in the chat that I'm trying to buy more of these latest ideas that I've shared in the drilling space. And as I look at my screen, unfortunately or fortunately, depending on your perspective, these fantastic bargains that I was hoping for are not available. I mean, I think the stocks themselves are very, very cheap, but I thought this was going to be sort of a equivalent of a Black Friday. I guess the Memorial Day sale was going to be spectacular. I was gearing up for this after doing some more work and clarifying that there is no deal, at least as of right now. And so, for better or for worse, some of these stocks haven't sold off that much. That being said, they're very, very cheap, and we're so early. And people normally tell you that we're so early when they're at, let's say, there's 126 rigs added, and they come up with some argument why this time is different. There's going to be 200 rigs added. We're only at roughly 20 rigs added from the bottom, depending on how you count it. And there's so much more upside for the drilling rig count here. So why does this matter? Because there's a lot of upside in these stocks. They're very, very cheap. And the stock ideas that I've shared have done very well. This does not mean that they will necessarily do well in the future, but I'm very excited about them. And I think there's a lot of valuation upside in a lot of these. And again, like, okay, so the stocks are down 3% and not 5% or 2% and not 10% or whatever today. That's fine. I think they're still wildly cheap. And I already own a ton of them. And so I was just hoping for a little bit more of a sale. Let's see if I can find. I want to find some metrics on just how cheap some of these drilling stocks are. It's going to take me a second. Let's see. Three track stocks with big upside potential. 4 ways to win. I'm going to share a couple more of these. Ideas. And by the way, there is a chat here. I'm doing this live. If you want to ask a question or share a perspective, think I'm totally wrong and there's already a peace deal and somehow I've missed it, um, feel free to share this. Let's see. Trying to find. Here we go. Yeah, there we go. Okay, let's see if I can share this. There you go. Stocks. As you can tell, I do these ad hoc. This is just fun. I probably should be spending some time with family. I will be shortly as we go off to barbecue and do other fun adventures. It's actually not that bad here in Houston today. Could be a lot worse. It's been sort of seasonally cool, which has been bearish for natural gas. That the South has been less hot than it typically is this time of year, but really nice for living here. So the stocks of the companies that I've shared here on Bison Insights, they're up a lot the oil drilling rig stocks. There's 3 of them that I've shared. They're up a lot, and they're still very, very cheap, and I think there's a lot of upside to them. These valuations that I'm showing, again, this is not a recommendation. You should not rely on them. They're from investment bank estimates and your consensus numbers. They're not including, in my view, this huge drilling boom that we're seeing. When I look at the consensus numbers, banks are maybe figuring the current oil rig count, maybe another 20 incremental rigs. They're not including the 100 plus rigs that I think are coming. And so I think it's pretty exciting to get to own these things at these giant discounts. And so here's another way to show it. If I shared a stock at $1, and again, these are just normalized prices. I share a drilling stock at $1. The stock's at, let's say, $2 right now, or today down 3%. Maybe it's at $1.95 or whatever. Getting to replacement cost could mean that it goes from this $1.90 or $2 to $7 or $8. And then as these companies, because they're generating so much free cash flow relative to their current share prices and relative, not relative to replacement cost. Again, this is sort of the key. As they generate all this free cash flow, you can buy back stock, pay down debt, buy additional rigs in the secondary market at a large discount, and compound value as they get towards my view of potentially getting to replacement cost. So what that does is, one, from the dollar, potentially there was a 7x or 8x or something implied in these stocks at a starting point without compounded returns. Obviously, there's a time value of money and so on, but excluding that, there was this, let's say, 7x or 8x potential from these stocks from where I wrote about them to where and share the ideas to where their replacement cost is. As they compound value, to the extent they trade to replacement cost, the potential upside actually gets amplified quite a bit. This 190 to 730 or $2 to $7 or 770, that could go from that to $20 if they buy back enough stock and pay off enough debt and so on. Their debt adjusted per share intrinsic value or replacement value or book value may actually rise quite a bit over time as this plays out. And so it's a very compelling dynamic, especially for the companies that are actually doing acquisitions and so on, in the middle of all this. And so, and here's the very important disclaimer. This is for informational educational purposes. It's not an offer, solicitation, or recommendation. Please consult an advisor and do your own diligence. Past performance may not repeat itself. That being said, these things are at giant discounts to replacement cost. To the extent that I'm right on this trajectory of drilling rigs rising, to the extent that inventory declines continue, which seems to be on track, despite all the jawboning and so on, there's a lot of potential for these things to do way better than people think. And frankly, there is a building case, and I don't want to get too ahead of myself. There's a increasing case that these things could trade to a large premium to replacement cost. Yeah, Steve, OTC markets are closed today. The TSX is open. That's what I was talking about. I'm not your financial advisor. I can't whatever, but I was looking to buy more of some of these stocks on the TSX. I thought there was a chance, especially this latest idea that I shared where the stock is up. It was up 15%, I think, from where I shared it to its high point. And I actually thought it might have traded down that full 15% potentially. Who knows, right? Like a lot of negative sentiment. The Bloomberg commodity analyst, whatever, is out there talking about $55 oil. There's a lot of victory laps of oil short sellers and various other folks. Sentiment's very negative. Who knows? Maybe the stock would be down. I wanted to own some more. I frankly, I try to be very careful with any sort of potential regulatory issues, front running, etc. I stop buying days before, for the most part, before I share a stock idea. I wait days afterwards before I trade it. In this case, I waited days afterwards and then started buying more of it. And on that pullback, I was hoping to buy even more. I thought the stock could have been down 5 or 10% today, just in line with sort of this negative sentiment. Oil down 5% plus or minus a little bit. It was down even close to 10% last night. And so I thought I'd get to do that. And right now the TSX is down 2%. So that's great. It's cheaper. But for where I was looking, this is already close to a 10% position for me. And so to add incremental capital, I need sort of an even bigger discount or even sort of more compelling reason than to get to that first 10%. Essentially, every dollar I deploy needs to go up more. Um, yeah. So I'd ask that since this is a live conversation to not share specific stock ideas that I published, just because this is an open conversation. So just as a request for the folks listening and actively commenting, it's great that you're commenting. I appreciate it. This is a lot more fun to do with sort of live engagement, but that is one request. So yeah, there are individual stocks that are down a little bit over the last little bit of time. That being said, some of them are up a lot, some of them aren't. Some are down. So it really varies. But my inclination is to buy the things that are one, the cheapest, and two, that I see having the most upside, and three, that I don't own as much of as I'd like to. And so this particular one, I did actually want to own more of it. And so I really want to, I was sort of, it's one of those weird things. One of my friends, this must have been 20 years ago, he was telling me about how the difference in between a value investor and a normal investor is a normal investor buys a stock and they hope it goes up. And that's it. And a value investor, he said, they buy a stock and then they hope it goes down 50% so they can buy more of it for cheap. And the investment management world is very complicated. There's lots of sort of weird tensions and so on. One of the things I really like about this whole newsletter thing and sharing my stock ideas is I can just really get with my sort of value investing roots and just approach it. I think just sort of the cleanest, purest way, which is just, hey, I like this stock. It's cheap. If it changes, then I will change my view on it. If there's one stock I've shared where the stock is down and there's a reason for it to be down. However, the expected value is still very positive. And I was sharing in the chat this morning that I've actually added a little bit in the last month or so because I think the expected value is still positive, even though there's a lot of risk there. That being said, if a stock falls and I think the thesis is broken, I'm selling and I'm exiting the position. I'm telling everyone that I'm out. If the stock is up, but it's more compelling here, I'm buying more of it and, I'll talk about it. And so, um, I think it's very hard, very easy for people to think that, right? Like, you know, if I like this shirt at $30 and it's on sale for $20, maybe I'll buy another one, right? Like if I like it, or if I was gonna buy it, but it was $50 and I thought that was a little too expensive. It's a nice shirt, but whatever. And then it's on sale Black Friday or something, $25. I'm probably buying it. But with stocks, people don't really have that same approach. And I think that's a mistake. And I think that valuation matters quite a bit. And as we've seen with these Bison Insights ideas, value plus catalyst can lead to material outperformance. Or as Vernon said, your stock picks are what I call the low hanging fruit. So, not always. Please don't rely on that. It's possible the next 15 ideas that I share will do worse than the last 15 ideas. It might even be likely that they do worse than those. The outperformance has been just astonishing and will be, I think, quite difficult to reproduce. Just to set the bar appropriately. Like it is not I don't think it's reasonable to expect that these latest stock ideas would do as well as the prior ones, just because the prior ones have done so fantastically well. Here, let me share this one. Um, I'm using words to share something that really can be seen via a chart. So I built this composite, and my assistant helped me put this together. And this is basically the large stock ideas. I shared sort of which stock ideas were large positions and which were medium sized positions and which were small around the time that I disclosed them. And then I also reiterated that. I did a year end walkthrough of the portfolio for all the paid subscribers. And I do sort of more frequent walkthroughs for the pro tier subscribers. And so this composite where I think it's 12% for large ideas and 6 or 7% for medium sized ideas and 2% for small ideas, and they just get added where the day that I disclose the idea, and then they get removed the day I remove the idea. There's one idea I've closed out. It was a warrant idea. It was very small. position. It was up a ton, and the risk reward changed. I exited it. It subsequently went up a lot and then down a lot, and so no apparent impact from my involvement in that one, which is exciting in terms of compliance and so on. It's nice to not be directly tied to the performance of some of these ideas, and so here's the performance of the Bison Insights composite. It shouldn't really say portfolio; it should say composite. It's just these ideas that I've shared, measured from the time I shared them. And then the remainder of the money or sort of percentage of portfolio that's not allocated is just sitting in XOP, which is sort of the benchmark essentially for these ideas. XOP is the large cap US oil and gas producer ETF. It's not XLE, which is the S&P 500 ETF for energy, because that's mostly Exxon and Chevron, which is not really anything close to what I do. And then this also shows the stock market. And this has been a bull market for oil stocks. It was not a consensus bull market. Everyone hated this stuff when I launched Bison Insights in August. People thought it was delusional and ridiculous for starting this thing. And they thought it was irresponsible to share oil stock ideas, particularly small company oil stock ideas. And not all the ideas have been smaller companies. A few of them have been, actually, one of them was a 20 or $30 billion market cap, and that's actually done great. It's done, I think, better than some of the other ideas and the overall composite since I shared it in December. So that's pretty fun. But they hated it sort of the whole way through, and the performance has been spectacular. So what I'm saying is, I don't think it's likely that I'll be able to share ideas that outperform the XOP by 70% in a year going forward. Hopefully, I'll outperform by 20%, maybe 30%. That's hopeful. Maybe it'll be a little more, maybe it'll be less, maybe I'll underperform in the next year. Obviously, I'm going to try to outperform as much as possible, but I think it's important to set expectations carefully and to not overpromise and underdeliver. So I will not promise to deliver this sort of astonishingly good outperformance of ideas. And again, this is not from me sharing these ideas. In the one case where I exited an idea, it actually went up quite a bit over the following month after I exited it. And it subsequently pulled back, but I think it's still above where it was when I exited it, even though it was relatively low trading volume and relatively small size. It did not matter. It went up a lot anyway. So my personal impact, me writing about these things from a measured perspective over time, does not appear to be material. This is a very important thing, both from a compliance perspective as well as an expectations perspective. You should not expect me to move the market through sharing an idea. You should expect the market to move if the idea is correct, and for it to move the other direction if the idea is wrong, or if there's some other sort of thing that happens or whatever that affects the fundamentals of the company or the market performance for these stocks. Just want to be very clear about this. Um, was chatting with a friend about this, and I think it's important to highlight this and to use that specific case of where I exited an idea and what happened to the stock afterwards, and or the related security afterwards. And I think that's a real test of what's going on. And what's going on is I'm sharing ideas. They move for a lot of different reasons. Occasionally they move a lot initially after I share them in both directions, and over time the expectation should not be that a price moves because I talk about it. It should be because, and it has been observed, because the fundamentals have changed. But anyway, the performance has been fantastic. Past performance is not indicative. I'm going to try and continue to try real hard to share ideas that can exceed this performance, but that is increasingly unlikely as the outperformance continues to compound spectacularly. Even today, I mean, just phenomenal day. Surprising these things are so cheap. Again, the U.S. market's closed, the Canadian market's open, and just looking through some of the stock. I mean, wow, this is really, really spectacular. Let's see. It's funny. My junior intern came by and used this to help distract her, and so I just had this on my desk. So let's see. What else am I going to show? I'm not going to talk about individual stocks that I like or don't like on here. hoping this morphs into a value investing. Yeah. So just to be clear about what my current plan is with Bison Insights, um, oil and gas are cyclicals, and so um, when we're in an upcycle, it's fun to own these things, but the risk reward gets less and less compelling over time. My expectation is as the risk reward morphs, um, as the risk reward morphs, I'm going to focus less and less on individual ideas. Um, I'll share ideas where I find really compelling ideas. And ultimately, um, it's not clear what exactly I'll do with this specific newsletter. I may end up transitioning it more towards tracking valuations and tracking ideas that I've shared and so on. Eventually, I think there's still really interesting ideas today, which I've been rushing to share, and I've been sharing in some cases quicker than the goal of one idea a month. I launched this 9 months ago and I've shared 15 ideas. So that cadence is slowing. It will slow more just as as I burn through some best ideas. But the, uh, my expectation is that will continue to slow, and eventually this may end up as more of a sort of broader oil and gas sort of coverage and tracking and evaluation type thing. And then maybe what I'll do is start another newsletter that's sort of more broad value investing focused and share other ideas. Steve, hopefully that's a helpful clarification on what I'll do with this. I haven't decided exactly. Let's see, refiners. So yes, so right now, so long-term refiners have decent tailwinds. However, unlike oil, there's been much more of an international build-out of refining capacity, and there's much more spare capacity of refining, as we've seen in places like Russia, where Russian refineries get destroyed all the time, and yet Russian oil exports and oil products exports are still quite robust. So broadly, there's some oversupply and there's been more building. That being said, there could be a shortfall at some point in refining, and there's certainly a shortfall in availability in refining in places right now, like the US. So refiners have done well. One idea, that large cap I shared, is somewhat integrated and has benefited from higher refining margins. That being said, the Strait of Hormuz right now is still effectively closed, and there's 13 million barrels a day of oil and natural gas liquid, essentially oil products that are being blocked via the Strait of Hormuz closure. There's only about 3 million barrels a day of refining exports that are blocked. So even if we had undersupply of refining broadly, right now we actually have net oversupply of refining capacity outside of the Strait of Hormuz relative to crude and crude plus liquids supply outside of the Strait of Hormuz. So to the extent that oil's up because of the Strait, that makes refiners actually less interesting, not more interesting. Again, the people I've talked to who own these things don't seem to be interested and seem to be actively avoiding this math. It's one of the odder things that I've experienced, chatting with folks who are numerate and yet are resistant to this. They just point to the recent crack spreads, which are the refining margins. And again, the margins have been good so far. I think that's temporary. I think as supplies level out to the extent that the Strait remains closed, I think that there's a lot of risk there. Here, let's see, Frank. I don't know if I can. Someone shared a link. Let's see if there's some big announcement that's happening while I'm talking. Okay. Um, Iran's foreign ministry. No, this was in the middle of the night. Yeah. Confirms that no Iranian nuclear agreements and uranium handover exist or will exist in any draft agreement. Yeah, a lot of this stuff, Frank, is just posturing. So anyway, the refiners, I think, are interesting from a longer term perspective potentially. In the short term, they're actually quite uninteresting. I think the owners of them are out to lunch for the most part, from what I can tell. I think the analysts covering them, I just don't understand what they're saying. Um, the biggest factor driving refining margins right now, from what I can tell, is a combination of limited oil supply to some of the Asian refineries, as well as the Chinese refined product export ban. And as those reverse, again, as supplies level out, I think that refining margins could fall quite a bit. And so I'm quite uninterested in the short term in refiners. In the medium to long term, they could do quite well. and it's just a question of valuation and entry point and so on. And a lot of them are trading close to book value. Some of them are trading at a premium to book value, which is wild. If you think about that relative to these drilling rig ideas I've shared and similar services companies, they would be trading at 4 or 5 times where they are trading right now if they traded where some of these refiners are trading. And yeah, the refiners are cheap in some cases on run rate free cash flow, but run rate free cash flow for a cyclical when it's not trading at a large discount to replacement cost historically has been a sell, not a buy. I'm not telling you what to buy or sell, but just observing cycles. They say that you want to buy hard assets at a large discount to replacement cost and sell them at a low price to earnings or similar multiple. That's just sort of general playbook for commodities and for cyclicals. And so from that playbook, refiners look like sells, not buys. And again, I'm not telling you what to do. It's just why I've not been so interested in the refining stocks here. That may change in the future. I think they're very interesting longer term, but they may be interesting longer term from a much lower price level than the current level. And again, I just haven't seen the refining analysts really navigating this Strait of Hormuz closure. They seem to be confusing a Chinese refined product export ban and limitations with the Strait of Hormuz. And again, it's possible I'm missing something. Maybe China is just never going to export refined products again, but that seems very unlikely to me. And so that's just why I think it's actually a helpful question because I think helps clarify why I like these onshore drillers so much and why I don't like the refiners very much because large discount to replacement cost. And yes, they are generating healthy free cash flow yields, but nowhere near their top of the market margins or capacity, whereas refiners are sort of way over the other direction. The equivalent would be there were some of these drilling rig stocks. So there's one I've talked about publicly, Ensign, and someone mentioned it here in this chat. So I'll talk about it. I own it. I'm not recommending it. The point of this is just to sort of share this illustrative valuation exercise. So Ensign at the top of the market, let's say in 2014, it traded over $15 a share. It was generating, I have to go back to look at the numbers. It was generating something like 3 or 4 times as much operating cash flow as it's generating right now. And so, um, it's just not anywhere close to peak margins or earnings or whatever. Steve, don't worry about it. It's fine. And so when I look at it relative to the refiners, when I look where the refiners were trading in 2014 at sort of the top of that sort of oil cycle, they're trading at radically lower levels, price wise, price to book, whatever. And now they're trading at way higher levels. If Ensign traded like the refiners did, or like they have, it would be like Ensign trading to like $30 a share when it was at, let's say, 15, but with the same earnings or maybe a little more earnings than they had back then. And so, which would be 4 times or something where they are now. I'm not saying Ensign's getting there. I don't know where they're getting, but probably not to that sort of extreme. Who knows? Maybe they'll get there. I'm not counting on it is the point. And they still have this potential to trade up back towards replacement cost. The amazing thing is in that time, they've actually bought a lot more rigs at large discounts to replacement cost. They've improved their fleet quality and mix. They've paid down debt. They put on debt and then paid off debt. They've shown remarkable resilience and their upside potential, again, frame versus refiners, maybe it would be 30 a share or 60 a share versus 4 or 450 or whatever now. Again, I'm not saying that they should get to that point, but I think just on a relative basis, this is where I'm so interested in these asset heavy businesses like Ensign. And again, this isn't to say, Ensign's the be all and end all. It's one stock idea that I've shared. I had shared it publicly before launching Bison Insights. I tend not to talk about individual stocks anymore publicly. That being said, because I'd shared it repeatedly and people were sharing it on the chat just now, figured I might as well just address it to give a specific example of where I'm finding value, which is drilling rig activity is inflecting higher, huge discount to replacement cost. And then the other thing that's just astonishing to me is I see people probably a few times a week. I don't watch BNN much and these podcasts and stuff, whatever. I just see these summaries. I try to watch some of this stuff, but a lot of it's just people that um, I don't think are paying that much attention or they have very significant analytical errors or other sorts of problems that just make it sometimes not productive to spend too much time paying attention to what they're promoting or arguing or whatever. But there are multiple mentions a week of Murray Edwards, the chairman of the board of Ensign. They're never in the context of Ensign. So often you see Canadian Natural Resources touted, which he is also in control of, and I think one of the largest shareholders of, and he essentially co-founded the business decades ago. He's compounded tremendous value at Canadian Natural Resources. He's also uh, compounded tremendous value at Ensign. One of the two people will talk about over and over and over again on television and the news and whatever, and they never mention Ensign. What I think will happen is in the next year, to the extent that I'm right about this drilling rig thesis and about 100 rigs or whatever getting added more on the oil side from here, is that we will start seeing more of these same folks or similar folks that talk about Murray Edwards on television right now in the context of Canadian Natural Resources, talk about Murray Edwards, self-made billionaire, oil tycoon, chairman of Ensign, talking about Ensign. And it doesn't seem like it's that much of a stretch. It's one of the weirder things. It's sort of similar to us finding out that there's no Iran deal and yet oil being down 5%, and with different justifications or whatever. Oh, it doesn't matter. And so in the end, the thing is the thing, and the price moves around wildly. And my business professionally is to go for clients, buy these things and hold them. This is not a solicitation, but underwrite them, hold them, and then sell them when they get towards intrinsic value. And now on this Bison Insights, I share ideas like this where I find things that are compelling. I own them. I share that I own them. I share why I own them for the most part. And then when I sell them, like that one thing that was up hundreds of percent, the risk rewarded flipped, I share that I've sold them. And so it's pretty remarkable. And I'm looking forward. I noticed that my oil market analysis too frequently it ends up being paraphrased, let's say. That's the polite way to say it. And I'll hear things that I've written. This is actually another reason to put out Bison Insights and put stuff behind a paywall. And I think I'm going to start putting more of my oil analysis behind a paywall too, market analysis, because I see this, like in some cases, the same wording. There'll be no one saying something, no one evaluating a particular important data point or market factor. And then I'll write about it or talk about it in a podcast or something, and weeks or months, sometimes days later, it'll be in a Bloomberg opinion or whatever article. It'll be in a Wall Street Journal article. It'll be in a Financial Times article. They'll never have quoted me, like 99% of the time, no quote, no citation, no whatever. And then, it'll be the various talking heads on oil or whatever. They'll say it really slowly and emphatically a month or a year or whatever later, and everyone will be like, wow, XYZ per so brilliant. And it's like, hey, this was this was here X number of weeks or months or years before. And so my thought is it's less about it's annoying to have ideas and analysis stolen without citation, but it's also, I think there's a value in being a client in my investment firm, and there's a value in being a paid subscriber to Bison Insights. And so I think I'm going to do a little better, having shown just this dramatic outperformance. The easy one to point to is just the idea performance, where I showed that composite. Bison Insights, the idea is up 110% versus XOP up like 40%, and the stock market up 10 or 15, something like that, from when I launched Bison Insights. Having shown that, I think I'm going to start pulling more stuff behind the paywall, some of it to avert plagiarism and paraphrasing and so on, uncited, and then some of it to just to preserve the value for the folks that wanna learn about this. And and if you don't want to, that's fine, no problem. Um, Anyway, the point of the Ensign thing was not about Ensign specifically. Obviously, I do like Ensign. It is a large position for me. I'm not recommending it. The point is that there's this just very obvious sort of visual, predictable discrepancy that I expect may, but there's no guarantee, will get resolved over the next year or so. And I would not be surprised. I'm not counting on it, but I would not be surprised if in the next year we start seeing a lot of folks talking about Murray Edwards and his relationship with Ensign, which is that he is chairman of the board and has successfully, carefully navigated that company for more than a decade. And then also that Fairfax Holdings, which is a famous company led by Prem Watsa, who is also a self-made billionaire, owns a lot of Ensign, bought a lot of it in the last couple of years. And I think between the two of them, they own close to 50% of the company. And so, you know, there's other companies that I also think are very compelling, but this one in particular, there's just such a big difference in between Murray Edwards in the context of Canadian Natural Resources and Murray Edwards in the context of Ensign, where no one hears about it. Broadly, I think this is also true on these drilling rig companies. You'll hear about these producers, you'll hear about pipeline companies, you'll hear about refiners, occasionally hear about offshore drillers because there's that um, these various famous folks that talk about these stocks and we're in them and they're up and they're down or whatever, but there's just not this focus at all on these onshore drilling rig companies, even though we're already past the inflection. They are inflecting, the rig count's rising a lot. I expect the rig count to continue to rise. This sort of nonsense suppressing price, it does slow the rise of the rig count, but it also makes it more persistent. The more barrels that get pulled out of inventory, the higher oil prices are going and the longer they're staying there. It's just a mathematical sort of truism. And so as that happens, the rig count's rising and staying there for longer than it would have been, makes these things even more compelling, and people are just not talking about them. And see a lot of stuff, again, try to track this stuff while not wasting too much time on it, and it's just not there. And again, I expect it to be there, and frankly, the more public I get on these things, the more likely it is that other folks are going to start sort of parroting this, and again, mostly just stealing the ideas and stealing commentary and so on. And so I think that'll happen. I think that's just sort of part of the cycle. At some point, it would have happened anyway. I won't be able to take too much credit for that, but it won't be a surprise if people are pushing these same few materially undervalued oil field services stocks that I've been talking about, with very similar sounding theses that was sort of expected. There's been some direct plagiarism of some Bison Insights articles. Those are actually easier because, like, from a legal perspective, it's actionable. They're paid newsletter articles that other people are charging money for it or whatever. So I'm going to deal with that at the appropriate time. But there was one in particular, ironically. So someone mentioned in the chat this company Prairie Operating, which was, so far it's performed poorly. The stock is down. I showed that on the chart. This is not about faking anything or hiding anything. I shared that idea. It's down. I own it. I'm not recommending it. Someone plagiarized that idea. So I was thinking, like lawyers, and then the stock's down a lot. So, and they just copied my thesis. I don't even know if they know anything about the thing. They just copied it. And again, I was wrong. Hopefully it works out, but there's been a partial catalyst and the stock went down, not up. So, that counts as wrong. And frankly, the numbers are the numbers. So, the stock is down and it shows up in that composite and it shows up on my chart. And if there's other things where I'm wrong, they'll show up too. And maybe it'll go up a lot and maybe it won't. And I've shared my view in the subscriber chat, and I've shared sort of what I'm doing with the stock. And anyway, I do think that was sort of a tangent, but I think that let's say a year from now, if I'd never talked about this, whatever, it's not really about me. After the inflection, as these companies are earning way more money, as the stocks are up, potentially, if I'm right, multiple 100% from where they were a year ago, where they were even talking about them now. There would be anyway people on TV and in the news or whatever talking about these stocks. Professional money management is much more of a marketing exercise than it is actually a money management exercise. 80 or 90% of fund managers underperform their indexes. I think even excluding commissions and so on, 70 or 80% of them underperform indexes. And so that's part of why it's so remarkable that Bison Insights ideas have outperformed and that my investment firm has outperformed. It's not a solicitation for it, but it's just extremely, extraordinarily rare to outperform a benchmark, especially over an 11-year period. Bison Insights is new, less than a year, so we'll see. That's part of why I've also been disclaiming so much that it's unlikely that Bison Insights ideas outperform by as much as they have, because it's just so rare. What people do as a part of that marketing exercise, and it's frankly foul in my view, but what people do is after a stock goes up a lot, they buy it and then they talk about it and they go and get associated with it. It's like a lot of these oil analysts that were ultra bearish oil coming into the year. Strait of Hormuz closes, oil prices spike, and then they're like pounding the table. Frankly, a lot of this sort of weird, narrative and speculative positioning and stuff has been those folks getting ultra bullish oil sadly to, I think, hide their ultra bearish perspective, which was wrong. Their data and analysis were wrong. There were not massive, there was no super glut, there were not massive builds in January, February of this year. They just kept projecting these things and they were just wrong over and over and over again. You can look at some past videos and past analysis that I've shared to see some specifics on this. Similarly, fund managers, sadly, um, come in and buy stocks after they've gone up and then talk about them. And it's like why you see some of these stocks talked about so much on TV or whatever. They're not your friend, and they're not in it to make you money. They're in it to raise money. And again, it's capitalism. You just have to understand what people's incentives are. And so, you know, my expectation is as these stocks go up more, we'll see more and more of that, and it'll be interesting to see. We'll see if I'm right. One, on the stocks going up. Two, one on the fundamentals. Two, on the stocks going up. And three, what happens? What the behavior is like on, let's pick Ensign. Let's track Ensign over the next year and see how many folks are getting on the financial news media and newspapers and so on, talking about what a great stock idea they have. Ensign at $7 or $10. At $10, it'll be funny. Oh, this thing, it's at, I can just like straw man it or steel man it. This thing, it's at 2/3 of replacement cost. It's run by this oil tycoon billionaire. The stock's up, but it's still cheap. Look, it's even cheaper now on free cash flow. Look at the huge free cash flow yield. Then again, it'll still be interesting, I think, at 10, but it's way more interesting at 450 to me than it will be at 10. 10 might be where I sell it. I don't know. Maybe I'll sell it at 15 or 20. I'm not sure. It depends on a lot of different stuff, but you can just channel what is going to happen, what you're going to hear about the generational buying opportunity in Ensign at 10. Um, or you could just sign up for Bison Insights and read about the next one that's going to be a generational buying opportunity after it triples on TV and so on. So let's see. And me saying this, maybe the same folks watch this and they choose to not tout this thing. We'll see. But this is still a fun exercise. I think they do it anyway, despite me talking about it. And there's over 100 people watching this live. Thousands of people will probably see this recorded. Let's see. It'll be the Ensign TV and newspaper test, and a newsletter test. Let's just see what happens with this, how much it has to go up. It's already up. I think it's basically doubled since I wrote about it first on Bison Insights, and I own a lot of it. I'm not selling it here. I think it's great. I think it's inflecting. I'm not recommending it, but just full disclosure, I own it. I've talked about it, and it's going to be so interesting. Yes, Ensign is a huge AI beneficiary. There's the direct sort of workflow thing, which is that there's more demand for natural gas. And so as natural gas turbines are sold out, and even the sort of reciprocating generators, which are much less efficient, are sold out. And as they're turning coal power plants into, this is my favorite, no one talks about this, but this company BW, I don't own it, wish I did. Stock's up huge. My buddy Judd owns it, was talking about it. Brilliant. They're converting coal power plants into steam generation for natural gas, which is actually quite efficient. It's quite brilliant that they're doing this. Other folks are going to get into it. I don't like the EPCs anyway, those sort of engineering firms. They're complicated. They tend to blow up sometimes. But I missed it, right? This thing was $1. My buddy at, why am I blanking on it? One of these was undervalued stocks or something. He writes this fun little newsletter here. He was talking about it at $1. Judd was talking about it at like $5. It's at 20 or whatever. And it's gone up because they're specializing Babcock and Wilcox there. And I don't own it. I'm not recommending it. I missed it. They're doing these conversions at like a gigawatt at a time of coal power plants, in many cases that are retired, over to natural gas steam generation. So there's just these enormous tranches. Almost no one's been factoring this into their supply demand models, by the way. It's really funny. I was pretty bearish gas coming into the year. I'm like still worried about it, but way easier to be positive or neutral on gas at 3 than at 5. And everyone was talking about gas at 5. People got mad at me for flipping bearish gas when I did at the start of the year. They really didn't like that I was bullish oil and bearish gas in January. And it's all in the reports and articles and so on. It's easy to find this. So there's this just giant wave of natural gas consumption, and it's not in the data for the most part, which is amazing. Like it's in the general power generation stuff is in the data, but these conversions are not. And then some of these reciprocated generators that are getting brought onto the market are not. And so lot like extra demand, which is fantastic. And frankly, some of these things, the backup generators are diesel, so there's some extra sort of sneaky oil demand just from this AI boom. So um, Ensign is also a beneficiary, and they talked about this, I think, in their Q1 call, and I've seen this in some of the research reports. I went to an investor day for one of the competitors, who's fantastic, and I think will do very, very well. They just have less operating and financial leverage to this increase in drilling rig counts versus Ensign. So that's why I own Ensign and not this unnamed competitor that I went to their investor day. On the way back from the investor day, I actually shared an Uber. We were out in the middle of nowhere outside of Houston, and shared an Uber with a brilliant investment bank research analyst who will remain unnamed. And he was sharing that he thinks that Ensign actually ends up being an even better beneficiary. They were later to the game for this automation and stuff on rigs, but they actually are benefiting from it because they're apparently vibe coding, so using Claude and other AI tools, some of their automation. And so they've taken these systems that would have cost, for some of their competitors, cost potentially $100 million or more, and they've replicated them for almost nothing. And the nice part is, with all their real world data and their ability to sort of real time test these things, it's not like they're putting something into Claude and then running it. They're putting into Claude and they're testing it and running, developers and having and engineers evaluating it, but it's cut the development cost on these systems down from hundreds of millions of dollars to millions of dollars, and it's cut the cycle time down from years to weeks or months on sort of the long end. And so they've been big beneficiaries. Some of the other drilling rig companies are also beneficiaries of this. And there were pioneers in this who have done phenomenally well from it. And so Ensign, I would argue, is a fast follower on the automation front. And as a fast follower, they're benefiting tremendously from their lower cost structure from having been later rather than being a pioneer on it. So um, they are benefiting multiple ways from this AI boom. I guess I went on a whole natural gas power gen tangent there. I've been thinking a lot about these coal to gas steam conversions. And if you think about it, it's really sad that these weren't happening more in the Biden administration. I think natural gas really got a short shrift from the sort of climate focused folks and CO2 focused folks. It's just so much more efficient, it's so much cleaner, and you get so much less of the other sort of toxic waste that you get from burning coal. I'm pro energy. I like all forms of energy, subject to EROI, subject to applying the right energy to the right solutions. Like, I was visiting a friend in Puerto Rico a month ago, and people have solar panels all over there. Makes a ton of sense. If you have to ship in your diesel and gasoline and natural gas, having solar power generation where your power costs 5 times as much as it costs in Houston makes sense. I wouldn't use it as a sole solution, but solar plus battery plus diesel backup plus grid, it's a great solution in Puerto Rico, probably in Hawaii and various other island countries. It's great. As a grid level solution here in Texas, it's asinine. In Alberta, it's even dumber. These things are just not, using a small amount of it makes sense in a grid, but using as much of it as they're pushing is unfortunate. That being said, a solution, if one were worried about costs and worried about pollution, both carbon and sort of CO2, and some of the pollution that yields acid rain and other sorts of real sort of toxic to humans and toxic to life on Earth type pollution, shifting from coal to natural gas is a win-win. It's just not so great for the coal producers, but it's pretty fantastic. And so it'd be really nice if more of that had happened instead of this IRA nonsense that the Biden administration had pushed. It would have been nice if they had pushed more, let's say, coal to natural gas conversions. These things are fantastic. It's great that Babcock and Wilcox is pushing this. It's great that some of these power generation companies are paying for it and implementing it. And it is the sort of thing where it makes sense for there to be some degree of tax abatements or subsidies or whatever to push these sorts of things forward. Imagine living near a coal power plant. It's actually the classic public good problem where a soot burning factory or coal or soot generating power plant and again, we don't really have soot, but there's a lot of sort of unpleasant emissions from these plants, is near laundry where they hang the clothes outside. So these days it would be, a house nearby, health impacts versus the burning. It solves a lot of problems to shift over, and I think we're going to see a lot more of it. So anyway, total aside, but that's actually a nice incremental bullish factor. It's probably the reason natural gas went to 3 and mostly stopped there rather than going down to, let's say, 250 or 2, which was a real risk given the oversupply that I highlighted at the start of the year. Um, okay, so I've talked about drilling rigs, talked about the Iran deal or lack thereof, the weird movements in oil prices, natural gas, AI, named a specific stock that I own a lot of. That was one of a few that I was hoping to buy more of if there was, uh, let's say, what is it? Uh, Selling that was irregular or extreme, or I'm trying to think of the exact word, but panic selling. So there doesn't appear to be that too much, despite the move in oil, and so um, such as life. I guess I didn't get the extreme opportunity that I was hoping, or that I guess perhaps expecting. And I guess that's good to see that there's some more steady hands on some of these stocks. I'm just checking some of the moves. Yes, irrational. Um, so anyway, very interesting day. I may publish this. There were some great questions, great engagement, and again, it is Memorial Day. And while I did talk mostly about stocks and other sort of economic factors, and this is not none of this was financial advice or solicitation or recommendation. It is worth remembering the sacrifice of those who gave their lives for us to be able to do fun live video chats about stocks and economic issues, and to remember the sacrifice of their families. And I had many relatives serve. Um, I have a cousin who's serving right now. My brother served, and I think thoughts for veterans who sacrificed a lot, and even more for those whose families and who made the ultimate sacrifice. So, with that, I'm going to close this up. Thank you for joining, and have a good Memorial Day.